Hello and welcome to this week's Money Roundup.
Just 2 weeks after Justine Greening's visit to our head office, we were delighted to welcome another MP this week. The Secretary of State for Digital Culture, Media and Sport, Matt Hancock, was a special guest speaker at our FinTech Central event, which was hosted at our head office.
Matt gave a fascinating speech alongside our managing partner David Harrison and senior partners. You can watch this full show on the True Potential Investor YouTube channel.
On June 15th, the Bank of Japan Governor Haruhiko Kuroda announced that monetary policy is to remain unchanged. The BOJ are sticking with regular bond purchases and leaving interest target rates at minus 0.1%. While leaving policy unchanged came as no surprise to analysts, the continuation of accommodative monetary policy is supporting economic growth.
Japan's private capital expenditure formation is also impressive. It is on track to increase for the 8th consecutive year this year. Bloomberg Economics state that capital expenditure is being driven by investment in new facilities and technologies, not short-term spending to adjust the temporary shocks of inventory cycles. This is good news for the long-term growth of the economy, as structural capex is less susceptible to monetary policy changes which can turn on a whim.
Ministry of Finance figures released on Monday show a significant increase in the value of Japanese exports and imports.
Exports increased by 8.1% over the year to the end of May, with their main exports, machinery, electrical machinery and transport equipment, growing at 9.9%, 11.3% and 1.7% respectively. Imports have also grown at a faster rate than exports, increasing by 14% over the year.
The yen has been strengthening as it is often regarded as a safety currency. Investors tend to increase exposure to yen when there is turbulence in the markets, such as increased trade tensions, which kicked off between the US and China at the beginning of the year. A stronger currency represents a headwind for Japan's export-led economy. Japan still manages to increase exports, showing they are highly competitive when it comes to trade.
In terms of debt, levels of debt in Japan have increased, with debt increases aligned with the ageing of Japan's population. Debt levels also reflect the legacy of Japan's banking crisis in the 1980s, when a large asset bubble in their economy burst, forcing the government to bail out the banking sector.
Members of the Bank of England's Monetary Policy Committee met on Thursday, and investors correctly predicted that the bank would not push for an interest rate increase this month. Before the meeting, the probability of a high rate hike was set at 2%.
Although the final no-rate rise outcome did little to get pulses racing, there were some interesting new features. For example, the bank signalled a hawkish tone in its meeting statement, saying it wants to move faster towards normalising monetary policy.
US banks are displaying an improvement in profitability and overall financial health. This coincides with the Trump administration claiming they are keen on rolling back some elements of financial regulation, believing a softer approach will promote faster growth across the economy.
With the climate seemingly turning more favourable for bank management, there is a move afoot to allow banks to step up the amount of money paid back to shareholders. From announcements this and the next week, US banks are hoping to be allowed to return $170 billion to investors through dividends and share buybacks. This would take place over the coming 4 quarters and represents a whopping 25% increase, provided they pass a 2-part stress test.
The US banking sector is one of the many sectors benefiting from President Trump's fiscal stimulus, primarily through tax cuts. A lower tax bill amounts to the saving of $3.6 billion in the first quarter of 2018 alone. At the same time, US banks are looking to repatriate cash from overseas, putting it to use domestically, America first.
The health of the US economy and its ability to withstand interest rate hikes from the Fed have steered an increased level of confidence between consumers and businesses. This is evident from a pickup in trading revenue and increased velocity of money. US banks' profits have been boosted by the steepening yield curve. This occurs when the difference between short-dated and long-dated treasury yields widens. This benefits banks because profits grow faster when spreads increase. However, spreads have been narrowing, which means banks are more reliant on volumes picking up.
The decision to allow banks to once again over-distribute is being criticised by many stakeholders. The main concern is that too early, following the hangover cure implemented in resource to buy behaviour, leading up to the crisis, paying out more than they earn is happening at a time when the yield curve is flattening. As a result, critics say this may encourage even more bank lending to make up for less profits earned from the spread lending. Health, strength and confidence is entrenched in the US banking sector.
Thanks for watching. Join us next week for another Money Roundup.
You can subscribe to our YouTube channel, True Potential Investor.